In April 2026, as the U.S. issued a 48-hour military ultimatum to Iran over the Hormuz blockade, the deepest assumption in global finance fractured. For decades, the market consensus has been absolute. When geopolitical conflict threatens global stability, capital immediately flees into precious metals. War equals a massive bid for safe haven assets. The empirical data from April 2026 directly contradicts that consensus. Instead of rallying on the threat of a Middle Eastern conflict, gold suffered a massive bearish gap down, aggressively testing its critical support floors. Silver matched this weakness point for point. Even amid widespread global panic regarding energy supply lines, the metal failed to catch a sustained bid from institutional buyers. The correlation between geopolitical fear and precious metal rallies has broken. In the 2026 financial regime, gold no longer functions as a fear hedge. To understand why gold ignored a looming war in April, we have to isolate a structural failure that occurred 3 months earlier, on January 30th. During a single trading session, silver lost nearly 31% of its value, falling from $114 to $78 an ounce. Gold dropped more than 11% on the futures market, wiping out over $600 per ounce. Physical supply constraints for these metals remained incredibly tight globally, yet paper metals lost a third of their value in a matter of hours. The scale of this disconnect suggests that these metals are trading less on physical demand and more on the internal mechanics of US dollar liquidity and derivatives positioning. This January crash did more than just move prices. It completely changed the structural architecture of the market itself. Explaining the April geopolitical failure requires an investigation into the January derivatives trap that changed the way this market handles liquidity. The first quarter of 2026 saw an intense speculative frenzy. Driven by fear of missing out on early year reallocations, retail and institutional buyers pushed silver up 62% in a matter of weeks. This enthusiasm concentrated heavily in the options market. Call option volumes on the iShares Silver ETF swelled to record highs, eclipsing the options volume on the Nasdaq 100 ETF. This chart details dealer delta hedging. When retail funds buy massive long calls, banks take on severe risk to offsettively buy underlying precious metal futures. This mechanical buying created an artificial price floor, tying upward momentum entirely to options hedging math. Commodity trading advisors, or CTAs, identified this rising trend and deployed algorithmic trend-following strategies, adding intense secondary long pressure to the market. The directional consensus of the market became overwhelming. Because the entire market was positioned long based on momentum and hedging math, the downside was dangerously illiquid. There were no natural buyers left below the current price. The architecture was primed for a single, hawkish macro catalyst to shatter the dynamic hedge and force everyone to sell at exactly the same time. The Q1 rally was a mechanical gamma trap, wound tight and waiting for a liquidity shock. That shock arrived on January 30th, when President Trump unexpectedly announced that Kevin Warsh would replace Jerome Powell as chair of the Federal Reserve. Warsh carries a rigorous reputation as a strict inflation hawk. His prior tenure established him as an advocate for rapid balance sheet reduction and aggressive monetary tightening. The prospect of a strictly hawkish Fed immediately strengthened the US dollar. Capital pivoted, and the rising dollar abruptly capped the precious metals rally. As prices ticked down, the microstructure reacted violently. Dealers, no longer needing to cover out-of-the-money call options, dynamically unhedged by dumping their futures contracts onto the market. This sudden wave of dealer selling pushed prices lower, which instantly triggered the cascading stop losses of the CTA trend followers. Regulators rely on circuit breakers to halt trading during sharp declines. Here, the system failed. The CME's circuit breaker only activates if a contract tracks 10. Energy markets reacted immediately to the threat of a closed shipping lane, pushing Brent crude past $110 a barrel on Karg Island supply fears. A geopolitical escalation threatens a Hormuz closure, driving oil over $110, bleeding into sticky U.S. consumer inflation. Concurrently, the market absorbed unexpectedly hot U.S. payroll data. This dual inflationary pressure priced out an April Fed rate cut. The Fed holds rates, the dollar rallies, and gold drops. The market looked at the Middle East and prioritized the inflationary consequence of the conflict over the geopolitical risk of the conflict itself. Higher for longer yields dramatically increase the opportunity cost of holding a non-yielding asset like gold or silver. When cash pays a high return risk-free, the penalty for holding zero-yield metals becomes severe. Capital bypassed the traditional precious metal safe havens entirely. Investors fled directly into the US dollar, establishing it as the yield-bearing safety asset during an inflation shock. On this 1-hour gold chart, notice the dynamic resistance bands at the 100-day and 21-day moving averages. We observe a power of three structure, a tight accumulation zone wedged between 4,680 and 4,720, followed by a manipulation phase, a precise stop hunt below 4,680 to trap early longs before a reversal. Algorithms attempted a technical bounce to fill the April 2nd gap, but faced extreme macroeconomic resistance. The strong US dollar placed a heavy ceiling over the market. The actual danger lies below. This deep value area at 4,576 is a total liquidity void. If the geopolitical ultimatum forces military action, the resulting oil spike will fuel inflation. That inflation will force the Fed's hand, strengthening the dollar and violently pushing gold down into this void. The 2026 precious metals market has moved past legacy safe haven correlations. Geopolitics no longer trade on isolated fear. War and supply chain disruptions now trade strictly through the lens of energy inflation and the anticipated monetary policy response to that inflation. The financialization of these metals through massive ETF option volumes means that technical positioning and dealer hedging mechanics will violently override traditional fundamental narratives. To accurately calibrate exposure, market participants must look past the headline anxiety of global conflicts. The true leading indicators of the 2026 regime are the CME options chain, the strength of the US dollar, and the Fed's terminal rate projections. In a high-inflation, yield-sensitive environment, understanding market microstructure is a requirement. When restrictive monetary policy and heavy options positioning align, the floor of the chart will simply vanish.